All right, we gotta make a video today. All right, it's such a momentous day. I can't not do it. And this time I got my mic working, so you're welcome. It's a little hot, actually. Let me turn it down a little bit. Hot just means it's an audio term. Just means it's going into the red zone, and it might like not sound cool, clear, whatever. Anyways, I lost a bunch of money today. Oh, but actually, I'm not that excited at all. It's I lost $11,000 in the value of the account, so it's quite big. But a bunch of stuff happened today. I mean, the crypto market's getting blown out of proportion at the moment. Let me take a look at. I'm recording this on the 11/9, so November 9th, 2022. And if you're listening to this in the future, it's been quite a momentous year. But everything's down. My Alibaba is down. My recent purchase down. Bitcoin's down to 16,400 as we speak. So broke that 2017 high 5 years ago. So pretty bad. The culprit, the catalyst of these events, and also, by the way, NASDAQ was down quite a bit too. I did have a little bit of a NASDAQ short, but I exited that a little early, so I didn't get much money, didn't get much hedging done, if that makes any sense. The catalyst for this was the FTX drama. Like, it's been all over Twitter. I mean, I'm not a crypto guy at all, but I like to listen to them and discuss, and I've tuned into some of these like Twitter spaces that people are talking about all kinds of crypto related stuff, and then it switched to the markets, and like hedge fund managers are weighing in, like financial advisors. Everybody's talking about it. Like, Twitter was blowing up today. I'm not a big Twitter guy either. Like, I just want to listen to what people have to say about all this. If you don't know, the CEO of FTX ran into some trouble, and the main guy from Binance Exchange started dumping FTX shares, or the coin FTT. I guess it's kind of like FTX shares, the way it's been explained to me. But it doesn't really matter what the deal is. What matters is that FTX is going under. That's what matters. Binance was going to buy it for like a minute, and then it pulled out. I mean, there's all kinds of drama. It's pretty exciting looking from the sidelines, although I'm not looking from the sidelines that much because it's affecting the entire market. It's hard to say what had more effect on the market, this crypto drama or the elections. I think actually the crypto drama had more effect than the elections. It totally overshadowed the elections. I don't think anybody ever gave 2 cents. I mean, in the financial media, of course, regular people care about the elections more, but in the finance circles, I think this blow up was a big deal. I think FTX was like the third biggest exchange, maybe after Coinbase and Binance. But it caused everything to crash down. I think not so much the election, but we'll never know. It's just speculation. So the futures are going. So I don't actually know how much the S&P dropped by today. Maybe we'll look into it when we do the comparison with the SPY on the account. So without further ado, let me show you these huge losses. All right, look at this, $11,000 down. I mean, I'm chuckling, but this is pretty tragic. So they started off okay, and then it just bad news stuff rolling in, and ended up down 6.67%. We're not counting the after hours here. Everything looks bad on the week. 1 month, this stuff was starting to turn green. 1 month still green somehow. 3 months really bad, 25% down. Year to date 16. 1 year 16.8. I guess I'm doing relative comparison here to start off the episode, and this is the all-time chart. It's always going to be green unless I have a really big accident. I started investing in 2018 August 28th, so that's why this chart is going to look a little flat, and it doesn't want to look at all because it's not loading. Conspiracy, Robinhood does not. Oh, there it is. All right, so August 28th, somewhere around here, 2018, so that's why line is flat beforehand. So anyway, still on the green on the all-time chart, which is good to see. Now if we go here through all these positions, you can pause the video player at any moment to try to figure out the exact positions, and all the information is contained within this little box over here. So if you're confused, just pause and read through it. These are my equity positions. I exited my NASDAQ short, so I only have 6 positions at the moment. Everything was down more than 3% except Realty Income for some reason. And that's the one I wanted to go down so I can keep my shares. I sold some call options against it, so I'm going to be exiting half of that position pretty soon. So a lot of things were red. I mean, even my watch list was red. Let's go into the account tab just to see the health of the account and what's going on from a bird's eye view here. I'm sitting at $301,746.31 total market value. What that means is that if I liquidate, that's not going to be the value of my account. The value of my account is going to be $155,752 because I've borrowed $146,000. That's not my money. It's Robinhood's money, and I got to pay interest on it. That's how it works. That's why this number is high. That's why it's 300,000. Okay, so I'm controlling 300,000 worth of like stocks and options, but they're all together. Everything is only worth 155. Make sense? Hope so. Okay, so this is the account from a total equity perspective. Apple dropped under the $100,000 mark for total equity that I own, even though I picked up 30 extra shares. So Apple's been taking it on the chin. Justified or not justified, it's being dragged down by macro events and recent events. Second largest position is Smith & Wesson, sitting at 93,300 or so, or 8,500 shares. That took a big hit today. So my two biggest positions lost like 3%. And since I'm levered, there goes your 6%. I mean, Paramount did pretty poorly as well. Everything's doing really bad. On total return, Apple is actually green. So is Realty Income and Main Street Capital. My three core positions are actually still green. Alibaba's down a little bit. Paramount, I keep going into Alibaba and losing money. I should really stop that. But anyway, the valuations are absolutely crazy. We can talk about it later if you like. If you want me to talk about Alibaba, let me know. I'll do that. Smith & Wesson losing me like 16 grand. You know, same with Paramount. Pretty poor performance. Let's compare my performance to the S&P. I'm jumbling it a little bit. I'm just kind of excited here. SPY is an exchange traded fund that tracks the top, largest, most profitable companies based in the United States. The one-day performance is only down 2% relative to my down 6.5% on the account. So I'm losing bigly. I'm losing bigly to the markets. 1 week performance is actually still in the green, believe it or not. 1 month is down 3.61. Up 3.61%. So losing to the markets on all parameters, except the 1 year and all-time charts. The 1 year I'm beating by like 8%. The all-time chart by like 60-70% at the moment. So recently the market's been kicking my ass, and that does not feel good at all. So okay, that is the account. And what is going on here? So in these spaces that I'm listening to on Twitter, I spent like a good 2-3 hours listening to it today, and it was really informative to see like how people are thinking about the current situation and valuations and etc. I also listened to a lot of financial shows. Some people are wondering what kind of financial shows I like to listen to. Well, I will list some that maybe you can check out. So one of them is a channel called The Compound, which is basically like a bunch of mainstream guys, okay, that they go on CNBC and stuff like that. Like that's where they made their names. They're part of like the RIA industry, registered investment advisor industry, basically like wealth management advisory stuff. So I like to listen to Market Huddle. I used to listen to Macro Voices. I don't have any more time to listen to that. I also listen to like Maverick of Wall Street. That guy's hilarious. You should definitely check him out. I used to listen to like Quoth the Raven and like just a bunch of perennial financial channels and shows that I like to listen to. But anyway, so I was listening to on Twitter these spaces, and people are still really bearish, man. And the thing is, even though they're bearish, whenever people were asked to disclose like what they own, rarely anyone, maybe like one or two guys were saying, okay, yeah, I'm all cash, or like I'm 90% cash, or like 50% cash, 40 bonds and 10 stocks or something like that, like value, energy or something. But it seems like it's one of those cases where there's still a lot of money in the systems. There are people sitting on cash, but there are also many people that are still invested. So you can't really say from like a flow's perspective how things are going to go. And it's just really interesting to hear like people's thinking about this whole situation. Some people were saying, hey, the Fed told us that they're going to be raising rates. Like, why are we still in the market like idiots? We should just never fight the Fed, this and that. It's so obvious, hindsight 2020 kind of stuff. But and they're but it has relevance because right now the Fed is still raising. They're telling you they're going to stay on course until employment cracks or something like that. So people should theoretically still be selling the market. And that might be the case. And as soon as employment turns, or that those little indicators tick the correct way when it comes to monetary policy, then perhaps people start buying stocks again. There were arguments being said that it's okay if you miss the bottom by 5%, 5 or 10%. Wait for a confirmation, plus macroeconomic indicators to turn up, and the market turns up 5-10, then pile in. So there's all kinds of like theories and suggestions out there as to how one should maintain or control their account. Some were suggesting that the days of market down 30%, buy everything you can type of stuff those days are gone. Basically, some people are suggesting that we're going to be in a declining / sideways market nominally for quite some time, and I'm not too distant from that scenario myself. I thought as soon as the 2020 crash happened, actually, if you go back and look at some of the videos that I did back then years ago, I actually thought that it's going to be lower for longer. I thought we weren't going to reach those 2019 highs, for quite some time, maybe for 4 or 5 years or something like that. And I was surprised, by 2021, like many other people. I did manage to capitalize on it a little bit. And now it seems like, we're paying the piper kind of stuff. But my whole outlook on this is that it isn't going to change like how I operate. I do believe that there's short-term reversion to the mean when it comes to markets. Like on a longer term period, I think that you could have a trend that lasts for many, many decades that doesn't revert to any kind of mean. You can have an exponential trend. And in fact, many of the currencies around the world follow an exponential trend. If you look up any currency that has a correlation with the dollar, for example, or gold, you will see an exponential trend on many places. Look at like Turkey or, Zimbabwean dollars, or Argentina. Their currency, was it the real? I forget. Or was that Brazil? Or both? Anyway, it doesn't matter. Whatever, some Latin American currencies, they have an exponential, curve against some of the more stable measures of baselines of transacting currencies out there. So I do think the exponential trends and linear trends can last for quite a while, but I do think that in short term, meaning like 6 months to a year time period, the market wants to revert back to some kind of a mean. And that's why I think that leveraging up into a sharp downturn or delevering into a sharp upturn is a good idea. I haven't been the best at catching some of those timings though, right? And nobody's good at timing. I tend to do things a lot very early, and then I pay a very high price for it instead of letting it play out over the course of like 6 months to a year. I guess I got to work on my patience. That's one of the reasons that I place contracts that are out like a month and a half, 3 months out, because I want to force myself not to operate into the account in order to gain the benefits of the sideways move and the reversion to the mean kind of mechanics. So let's look at where we are actually. Let's take a look at the SPY, for example, because that's kind of considered the benchmark for professionals. Oh, that's the Goldman Sachs. Misclick. Let's go to SPY and see what it looks like. Or we can look at the VOO, it doesn't matter. But here's the 5-year trend. You see that like every sharp downturn has afterwards a sharp upward turn. And that's just how markets work. There's always this like short-term reversion to the mean over the course of like a month or 2 or 3. Sometimes 6 months, sometimes a year and a half. As you can see, This one took quite a while, from February 2020 all the way down to March 2020, and it bounced hard until December 23rd 2021. So that one lasts like a year and a half. But it had sharp movements down and up in between. It's not, the market's never like a smooth line. It's always jagged, right? So anyway, that's my idea here. I'm gonna keep profiting from that, or try to the best of my abilities. Short term, it has definitely not paid off, right? As you saw my chart, on the 3-month chart, I'm down like 25%, which is just abysmal relative to the market. I mean, I'm in names that I thought were value names, right? I mean, Smith & Wesson, Paramount Global, but each of them were plagued by their own problems. Smith & Wesson is a more like idiosyncratic problem that they have with moving and laws and regulations and stuff, and Paramount has a huge reliance on advertisement money. And so when the advertisement pool dries up, you see companies like Meta and Google and all of the other advertisers struggle. Amazon has a big advertising business as well. And Paramount is no exception. It's a media company. That's what they make their money on, is advertisements. And when that pays less, everything goes down, right? Revenue, earnings, all your ratios get deteriorated. You start accumulating more debt so you can keep the business afloat. And these kinds of emergency situations can last for quite some time. Emergency meaning having to issue shares and debt in order to keep the business afloat at a level that you had previously. Some companies are taking measures before that starts to happen. For example, Meta just announced like 11K jobs going to get slashed. Obviously, Elon's Twitter deal made him cut like, I don't know, 80% of his workforce or something, like 90% of his PR staff. I don't know how many people were fired from Twitter, but I'm sure it's in the thousands. And he also fired people from Tesla as well. But Apple announced a hiring freeze not too long ago. They may be laying off people too, I don't know. But Apple's earnings actually looked pretty good on this quarter. I do find a little suspicious that they were kind of really quiet about their projections for the future. The only projection I think that Luca mentioned is, I think that's their CFO maybe, is that the growth is going to be less than 8% that it was last year, which is like, okay, it could be 5%, it could be 1%, it could be negative 20%. There's no projection there whatsoever. But even a company like Apple that's just based, logistically and product-wise and everything else, management-wise, even they're running into some headwinds. Like Mr. Maverick of Wall Street mentioned, their services revenue is starting to deteriorate a little bit, and they've seen a sharp downward spike in services spending on their platforms. But everything else is still holding pretty strong. Personally, I was of the opinion, and I still am of the opinion, that the iPhone Pros are going to have a record selling quarter over this holiday season. I think that people who think they're not going to upgrade to the 14 are just kidding themselves. You're going to get a 14 Pro for Christmas. It's going to happen. There's no way it isn't. And all these birthdays that are happening in the next few months, everybody's got a birthday in September, October, November, December. I mean, that's just a fact. And so, they're all going to get their iPhone 14s. There's going to be a lot of angry teenagers, over the holidays, and they're going to get their iPhone 14 Pros. So even though the demand for the 14 base model is completely non-existent, the Pros is still, I think, going to do okay and going to score a record quarter when it comes to sales. I just don't know whether that's going to be enough to pull through and score a record top line and bottom line like they usually do on the next quarter after the holidays. I don't know if that's going to happen, but it could. So personally, I'm a cautious optimist for the near term. I think there's going to be about a sideways grind for the next few years as we work through the inflationary situation. I do think that this is going to be peak pessimism. The lows in the markets are going to be scored in November this month. And I think it's going to be the super hot inflation print that comes in this month because they're going to be announcing the October inflation print, and I think October is going to come in hot. Energy was it's not going to be hot because the gas stations and all that are a pretty good indicator of that, and the prices weren't terribly elevated. But I think food inflation and all the other inflations that are kind of trickling from the energy are going to be bulging in the whole inflation chart. This is my bulging sign. The whole inflation chart is going to look like, it's going to look interesting. But I'm guessing it's going to be like around a 9.6 or even 10.1, somewhere around there. Like inflation is going to be huge. I could be wrong, but this is my thinking. Usually the reason I say that is because seasonally, the October inflation print has been one of the hottest ones of the year. If you go back like 10, 20, 30 years, you'll see that October is pretty inflationary. And then it kind of simmers down afterwards. I don't know if it's a seasonal thing or what have you, but usually the December, January, February, the inflation numbers don't look very high. And that's about the time where inflation started picking up last year. So the year-over-year numbers are going to look very, very favorable. In fact, I'm willing to bet then that after a 9 or a 10 print being announced this pretty soon, maybe like a week or something, the next month or in January, we're going to get a December or a January print that's like in the 5s or 6s. Now, this is super controversial, right? Because inflation doesn't normally subside, but the way it's measured is on a year-over-year basis, right? And so it's going to move like a wave across the entire year. And we're going to be measuring the next year's inflation with a baseline of a much higher rate that happened the previous year, if that makes any sense. I don't know how to explain it better, but so anyway, I think inflation is going to definitely simmer down, and it might even reach the 2s and 3% over the next summer or spring or fall. So that's my prediction here. I think it's going to be fairly neutral to the markets. I don't think that markets are going to believe this, that everything is okay. Federal Reserve may actually take a sign that, they've said that they're going to keep the rates fairly high for a fair amount of time, or at least does Jerome Powell's wish. So unless something breaks, unless the market is surprised by some kind of event, some kind of technical event due to some rule that randomly gets implemented in the financial system, which is kind of the culprit or the catalyst for a lot of these market meltdowns that happen within a couple of weeks, 20% down in 2 weeks or something, a la 2018. Unless something like that happens, Jerome Powell's kind of dead set on keeping the rates high for quite some time and doesn't necessarily want to cut. I mean, the days of emergency measures are over, right? That was the teens. That was the 2000 teens. 11, 12, 13, 14, 15, 16, 17, 18, 19. We were on emergency low rates, emergency measures. So those days are gone. They no longer exist. Now the big boogeyman is inflation, and it's going to be getting fought by the Federal Reserve. What they care about the most is their legacy. They care about their credibility. In fact, everybody cares about their credibility. So they have to be able to follow through on what they say. So they're going to crush demand until they see joblessness, until they see some bankruptcies. We see it in all the speculative assets right now. I mean, ARK dumped like a year ago, right? ARK was dumped. China dumped. Everything is this growthy or uncertain is just complete dumping. And today we see it with the crypto world as well, right? So something that's growthy has perhaps a very long run potential, like 10, 20, 30, 40, 50 years ahead. All that stuff is crashing. The higher the rates are, the more now matters. Like, what have you done for me lately kind of stuff. So every company is struggling to turn profitable in a hurry, so they can keep some of their investors and some of the funding coming in from the equity markets. That's what all the big tech players are doing. That's why I personally like Apple, because it's one of the few companies that actually really cares about profitability and their shareholders from day one. They don't need this catalyst in order to start tightening up their, well, I shouldn't say tightening, but focusing on returning capital to shareholders, profitability and growth and moderate growth and smart growth and building out logistics systems and things like that. So that's why I really like Apple and why I'm confident this company will survive. But there is also a thought here maybe I should bring up Apple when I'm talking about it. There is a line of thought that Apple has not been hit. Like, this is the 1 year chart for Apple, has not really been hit as much as other tech giants. I mean, on a 1 year basis, on a year-over-year basis, it's only down 10%, which is about in line with my account. I'm down like about 12%. But if you look at, companies that used to be considered some of the, darlings of Wall Street, the FANGs and whatnot, year-over-year basis for Meta, for example, is 70%, right? So they weren't really focused on profitability, were they? They didn't even pay a dividend. So how about Microsoft? Microsoft is down 33%. Not as bad, but still a really good hit. How about the best company in the world, some say? How about the Alphabet Class C? Down 41% year over year. That's pretty massive. Okay. What's another company that's that people used to like a lot? Netflix. That's a giant, right? Look at this one, down 60%, 61%. 61%. So these were firms these are part of the FANGs, right? The companies that used to comprise the majority of the growth in the stock market, and now they're gone. Those are all the growthy names. So all of them been hit except Apple. Like, Apple is standing strong and it's kind of holding up the market at the moment. It's showing some cracks today because it dropped 3%. And I think the reason is because it's having its own problems. Like, it's having, what were the problems that they've had? They had some supply chains. They had China problems, due to the lockdowns. And so they're thinking that there's going to be a supply issue when it comes to being able to sell their Pro phones. I don't really buy it. I mean, Apple's so good at logistics that they can even deal with that. And now they've actually started to diversify the locations in which they started producing phones. I think they're producing some in India now. And that's cracking up, real fast, those developments, as far as I hear. So I have full trust that they're going to be able to survive this period. Will they get hit for no reason? Well, not for no reason, but will they get hit by the rest of the stock market? Of course. I mean, many people, I don't know, many people trade through ETFs, through exchange traded funds. And by definition, Apple's in all these funds. So if they decide to reduce their stock exposure, automatically there's some selling on Apple. The one thing that always happens, though, is all the retirement funds of all these employees everywhere in the US now, everybody has a 401k, or virtually everybody who has a real job has a 401k and a retirement account. And where does that money go? It goes in indexes. They follow the markets. Virtually every single index contains Apple. So all those inflows, the longer time passes, the longer it goes, all these people with regular jobs, that survive this entire thing, we're going to keep pumping money into their 401ks. And stocks have prices, and they're going to get elevated by these money flows that I count on happening month after month. So the longer this goes, the longer, I become more and more confident that things are going to revert back to all-time highs within like 3 years at the most, maybe 4, is what I'm thinking. It's not necessarily going to happen. There could be other outsized events, but I think the inflows are stronger now than they've ever been, maybe besides last year. But the trend is upwards, and the US is still growing in population. More and more jobs are being created that pay out into 401ks and retirement accounts. And also the population is becoming more and more literate about finances, and they start investing too, which is part of why the whole retail boom in last year caused such an uproar in the market. But anyways, I've been talking for a really long time now. Hopefully some of that stuff made sense and was either entertaining or valuable. Obviously none of the stuff I say is financial advice. So make sure that you're careful with your finances. Don't invest in FTX. We just lost 100% or close to 100% of its value. I think I heard the CEO say that they're on the hook for like $8 billion in deposits. apparently there's theory where he's been funding, his pet projects from consumer deposits, basically, more or less. So anyway, I don't want to get into the details. You could probably find out more accurate information elsewhere, but I just thought the news was exciting, and the fact that, not in a good way or in a bad way, just exciting. And I thought that, I just like to see movement in the markets up or down. Um, so what was I gonna say? All right, look, that's already 30 minutes. It's way too long. It's way too long. If you thought this video was way too long, tell me in the comments. All right, I want to hear about it. Cool. Peace out.